Weekly recap. Market correction. Due to inflation and trade policy concerns. Key developments. All three major indexes fell by about 2.5% during the week. S&P 500, 2.6%. Dow Jones, 2.5%. Nasdaq, 2.5%. Main reasons. Rising bond yields. The 10-year U.S. Treasury yield climbed to its highest level in months, putting pressure on growth stocks, especially technology. Credit rating downgrade. Moody's downgraded the U.S. credit rating, raising concerns about public finances. Trade policy worries. President Trump threatened to impose a 25% tariff on iPhones and a 50% tariff on EU goods, stoking fears of an escalating trade war. Tech stock volatility. Apple dropped 7.6% this week, due to competition and tax concerns. Short-term market outlook, continued volatility. Likely supporting factors. Strong business results. Major tech firms like NVIDIA, Salesforce, Dell, and HP are set to report earnings next week, which could drive market gains if they beat expectations. Key economic data. The PCE index, the Fed's preferred inflation gauge, and Q1 GDP data will be released, providing more insight into the economy. Fed speeches. Remarks from Federal Reserve. Officials could shape expectations for monetary policy. Risks to watch. Inflation and monetary policy. If inflation data is hotter than expected, the Fed may keep interest rates elevated longer, pressuring markets. Trade policy. Any new tariff actions by the Trump administration could further shake investor confidence. Summary. Positives. Solid Q1 earnings from major companies. Upcoming economic data could improve investor sentiment. Risks. Rising bond yields and persistent inflation may weigh on stocks. Trade policy uncertainty continues to be a source of instability. Current market analysis. End of May 2025. Positive points. Strong corporate profits. Many S&P 500 firms, especially in tech, industrials, and energy, have beaten earnings expectations. U.S. economy remains resilient. Despite inflation signals, indicators like GDP growth and personal consumption show economic strength. Investor sentiment is stable. Capital hasn't exited the market, but is rotating across sectors. Risks and uncertainty. Monetary policy pressure. Higher government bond yields raise borrowing costs and challenge stock valuations, especially in tech. Trade tensions resurface. Tariff threats on European and Chinese goods are reigniting short-term instability. Possible technical correction. After a long rally, the market may pause to consolidate before further gains. Advice for individual investors. Avoid FOMO, fear of missing out. The market may rise, but not all stocks will. Focus on quality businesses and reasonable entry points. Prioritize defensive and strong cash flow stocks. Examples: consumer staples, healthcare, and energy. Industries less impacted by macroeconomic shifts or rate hikes. Closely monitor earnings reports and guidance. Don't just look at past results. Management's outlook for future quarters significantly influences stock prices. Hold cash or defensive instruments. In volatile conditions, keep 10 to 20% of your portfolio in cash for flexibility during market dips. Consider ETFs like SPHD or short-term bonds. Watch macroeconomic data closely, especially CPI, PCE, job reports, and Fed decisions. These shape institutional behavior and major capital flows. Recommended investment actions: short-term, 1-3 months, trade actively. Follow policy-related news and focus on stocks with specific catalysts. Mid-term, 3-6 months. Favor companies with stable earnings growth, less exposed to interest rates, e.g., infrastructure tech, renewable energy. Long-term, 1 year. Gradually. Accumulate high-quality stocks with competitive advantages and strong leadership. Use pullbacks as entry opportunities.